Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Mark, happy Friday. I see you're on the road and in my neck of the woods at that.
Yeah, happy Friday. I normally don't look good, but I look really bad today because the lighting in this hotel room is terrible. I am at the Ink 48 Hotel, INK, way outside of the city toward where Pomp is having his Bitcoin Investor Week. So I'm on panel later with DTAP, Dan Tapiero. And just quick reveal, they did request, I did have a suit on yesterday. So today they want me to wear the orange pants. So I do have the Bitcoin orange pants on. So that's good. And the sock game, I'm the optimist. So I've got the Bitcoin rocket ship on. Why do I have the Bitcoin rocket ship on when we just had a 27% correction? Because, we all
springs eternal.
This.
Because
I want to go to this better planet, right?
Yeah.
And the way you get there is with a rocket ship. And I think we'll see. I think we're ready for blast off to the final leg of this bull run. I do actually think that the winter will come back at the end of the year, and we'll have another meaningful correction. Sadly, but we can talk about what happened here over the last couple of days, having to do with the unwind of the carry trade that a lot of hedge funds and institutions are doing, but lots to talk about.
Yeah, so much to get into, Mark. And I think, the regular listeners of the show know that, we are just calling balls and strikes a lot of times. So when there is positive news in the market, of which there has been much positive news on the crypto side, we are quick to kind of say what that could mean, not just for the present, but for the future. And also, I remember, Mark, when we recorded those FTX episodes where there was a lot of uncertainty and prices coming down to, below 20,000. So, not losing 20,000, they were 20,000, right? So we are at a point now where, a lot of folks have gotten in, like many financial instruments, towards the all-time high, and are experiencing some of that pain. So kind of, while it's very difficult, Mark, as you know, to draw one single reason why the market will move, from one direction to the other, there are a couple of events this week that were fairly significant that folks are sort of clustering around as potential rationale for this sell-off. So the one big one is the Dubai-based Bybit hack, which was unfortunate, right? And so we spent some time talking about this internally, trying to figure out, what exactly happened. And there was, a lot of uncertainty, but then quickly, actually through the power of the blockchain itself, the little b, that's able to show why the system, has some good things about it, and then can also obfuscate, given you have some layers of decentralized players that don't KYC, that can kind of create a little bit of some murkiness. But I think given enough time, this will be tracked down. But maybe at the top level, Mark, I can lay out some of the timeline here, and then you can kind of chime in as far as what was really occurring here. So basically, you had the beginning of the old-fashioned. What we always say is, it's not just the technology itself that breaks down. It is some of the people processes that happen. So this began with a phishing attack, which is when somebody uses a misleading channel, emails, text, et cetera, to fool the user into disclosing the private keys or seed phrases. And I think that's really significant, right? Because when people think of crypto as being insecure, they automatically think to a problem in the code. And no, it is usually just revealing information that you need to access the system. So it kind of started into that process, right? And then from there was, some element of malware where they set up this portal, which kind of looks like the right interface, but it's actually the wrong interface. And of course, this had to be North Korea because, state-sponsored attackings have occurred, not just in this, but in, really other heists of magnitude, especially when you can do this digitally. You don't have to go into some place with a paramilitary group. And then from there, Mark, the warning signs were already cast because they intercepted a trade that was supposed to go through on Ethereum. So, of course, you're going to have some fun today, probably. I'm sure Pomp will say, see, the Bitcoin blockchain has never been hacked. And, of course, he still is correct, regardless of kind of the transactions here. But it was an Ethereum-based hack intercepting that transfer. And it was a big one, Mark. It was a 1.4 billion with a B. And then from there was this kind of tentacle distribution, as is common. It didn't just sort of go to one wallet and rest. It went to many, again, through those decentralized channels, through the non-KYC channels, so that you can't really have a process. It's not like somebody is in a Fidelity account and, has their real ID or passport to set that up. Yeah. And the idea is that people are going to lose steam here and not going to want to track this down. So the hackers think that they might be able to get away from that and they'll kind of lay low for a while. But that's so far what we have gotten. And it's been enough to spook the markets as some people have some concern along with other macro events.
Yeah, look, I certainly think there was concern. Anytime there's a problem in any system, mm-hmm. there is concern. I mean, I think back to a few months ago, people went to the bank to punch in their code in the ATM and it flashed $0. This is a Bank of America problem. It was a software glitch. And people like me were like, okay, do I need to move my money out of the bank? During, the lockdowns in 2020, when people were talking about, the banks, potentially being insolvent, I actually did move money into my kids' accounts and to just in case, because you're only insured up to a certain amount. All the money in the bank isn't insured. So this morning I read just before we came on mm-hmm. that a human accidentally fat-thumbed what was supposed to be a $280 transaction at Citi to 81 trillion.
Oh, wow. They didn't hit the character limit. That's amazing.
Yeah, exactly. And so now they found it and they fixed it. But I think all that is real, and it certainly creates some angst. But I think there's more to the story here, particularly when you look at, Ethereum is definitely going down partly because of the hack. Partly people are they're questioning, is this as reliable a system? It's funny. I've told the story on the show before that when I first got into crypto, way 100 years. No, I'm just kidding. Back in the 2013, 14, 15 range, I Googled who is Satoshi Nakamoto, right? Trying to figure out who is this person who created Bitcoin, and what comes up if you do that is Intelligence Central, because Nakamoto is the surname of families that live in the central provinces of Japan. So I'm pretty psyched. I'm going to Japan here in March for an Editline board meeting, and then going to tour around with my son and wife. We're going to see all of Japan. I've only just ever been to Tokyo, so I'm pretty excited about that. But from the central provinces, so we'll go to the central provinces. We'll try to find the Nakamoto household. No, I'm just kidding. But Satoshi means intelligence. I'm like, whoa, Intelligence Central. That's way too close to CIA. So, well, what if this was created by the NSA CIA, and what if it was created to get all the bad money, right? The dollar was collapsing and being devalued. Get it into this good tech, and then they've got a back door, and they're just going to steal it all and pay off the debt. And my head was spiraling, and so I was, Scott Stornetta, who is one of our venture partners. He's the guy that coined the term blockchain in 1991, Stanford PhD in all kinds of things related to, physics and statistics and all kinds of amazing stuff. But so I was relaying the story to him one time, and yeah, he said, no. Like, Scott, you didn't even think about it. And he says, well, no, the way you're thinking about a back door is impossible in Bitcoin because of the air gap and the way the system works. It's not possible. There can be no software backdoor. But with Ethereum, there could. I mean, like that fast. He was like, there could. So, and I'm not saying there was or is and that North Korea came in the back door, but what I'm saying is different code bases have different strengths, different weaknesses. And in digital assets, you can be fast or you can be secure.
Yeah.
Can't be both. And it doesn't mean you'll be insecure, but you can't be super, super fast and super secure. I mean, look at Solana. Solana's super fast, and every now and then the whole system just crashes and transactions get vaporized. I know the Solve people don't like me when I say that, but it does happen. Mm-hmm. You have to redo your transaction. You have to hope that the other person is still around. And so Bitcoin is slow, but it's never, not once, ever been breached, never been hacked. And that's why I believe it's the hardest money. It is the base layer of money.
Well, Mark, question for you, since you're going to be getting ready to go on an expert panel with our buddies in NYC, as we start seeing the institutionalization of crypto continuing, do we see any crypto insurance for an individual from an FI? Because I see and we hear a lot of these hacks, they're not with the protocol, but they still affect the user because they're kind of as they access the asset, excuse me. So is that something that people talk about? Is that something that people need?
No, it's a great point. So this insurance is what allows any industry to function, mm-hmm. right? You couldn't own a home and get a mortgage if you couldn't insure the home.
Right.
You couldn't drive a car if you can't get insurance. You couldn't grow crops if you can. I mean, you could grow crops, but most farmers get insurance
right
against disasters. And so you can't have a beach house if you can't buy insurance, right? They won't let you do that. So all of this comes down to insurance allows the pooling of risks. And in digital assets, a bearer asset, there are multiple new risks, well, old risks, like we used to have bearer assets, and then we went to, trust-based system where you put your bearer assets in an institution and you get an IOU, and that's a different system. You have different risks. But yes, the answer is we had multiple presenters yesterday who are building insurance companies. One really interesting one, building a Bitcoin-only insurance company where you're not converting from Bitcoin to fiat or fiat to Bitcoin. You're securing your risk in Bitcoin, and you're getting paid in Bitcoin. And that removes some of because you think about it, if you bought $1 million life insurance policy 5 years ago and it got paid out today, you lost half the purchasing power. It's a crazy thing that people never really think about in fiat. But your point specifically is, well, what about insurance on transactions or insurance on your assets? Like if you deposit your assets in an exchange, are they insured? Now, what Bybit did and what Binance did when they got breached and others have done or failed to do is they self-insure, meaning they take some of their profits and make their customers whole. So there is no FDIC-like insurance yet for digital assets. I think that will happen. Probably won't.
You would think so, right, Mark? Because FDIC is basically talking about assets that you are holding within the bank. And if more banks are dealing with crypto, well, A is to B as B is to C. Therefore, A is
transitive law. So no question. But the other one is this attack against, I hate to call it a terrorist act, but a malfeasance attack is a business interruption risk or another form of liability. So there are definitely insurance policies against this type of thing. And that allows you to have systems that have risks, right? I mean, you could control all your risks. Like I could sit in this little hotel room and take no risks today. I would risk not getting hit by a car, walking around the crazy streets in New York, which I did learn. Never look at your phone and walk.
Oh, no.
Because bad things can happen because people do. I mean, there's lots of people, lots of cars. But I want to segue onto like what happened. Why did Bitcoin drop 27%? What's going on? Well, look, volatility is the price you pay for superior returns in every asset, right? Why is Amazon, again, for the 30th year in a row, in a double-digit drawdown? Every year for its 30-year life, it's had a double-digit drawdown. It's currently in a double-digit drawdown, as is Google, as is Microsoft, as is Tesla's down 42%. So things go down. Well, what is that reflecting? Well, it reflects uncertainty or disagreement about the future outcome. Right? There are still people that don't believe that EVs are going to rule the world for Tesla. There are still people who believe that e-commerce isn't going to. There aren't very many left, but also what happens is assets. We've talked about this too. When they're below fair value, investors buy them and they hold them. That's what they do. They buy things on sale and they hold them until they get back to fair value or above. As the price starts moving, the traders come in. The traders don't really care what the price is, or they just want movement and they want to scalp hot, longs and shorts. When the price starts to get close to fair value, the hedgers, the people who produce, like a Bitcoin miner, for example, a Bitcoin miner holds it until it gets to what they think is fair value. Then they'll sell it to cover the cost of mining more Bitcoin, securing the machines. And a hedger has an opposite side of the transaction, a speculator. So speculators come in. Again, they don't care what the price is doing. They just want to take the other side of this hedge. Then what happens is the gamblers come in. And the gamblers start buying and they push the price of an asset up above fair value. And then they start to use leverage. And so you look at stocks. Stocks are at their highest level above fair value in history. Worse than 1929, worse than 2000, worse than 2008. I mean, at levels we've never seen, like the Buffett indicator, the market cap to GDP, 217, like 100 is where it should be. Now, some say, well, no, in a new world with better computing, it should be 130, 140. Fine. I don't agree with that, but fine. But 217 is just wrong. And so all these stocks got to this point where they were vulnerable. And what happens is the Trumpster says, trade wars, easy to win, they're back on. And things start to go down. Well, what happens is you get a margin call. If you bought these stocks on margin, we had the highest margin debt in history because, buying stocks is great. Well, buying stocks with someone else's money is even better. So let's do that. So that pushes the price even higher. Well, then they start to unwind. You get a margin call. Well, you can't sell the asset to pay the margin. So because it's down. So then you got to come up with money. Well, you don't have any money because you've been borrowing money to buy stuff. So you got to sell what isn't going down. So you sell some bonds maybe, or you sell some gold. So gold went down. Then you start selling Bitcoin because a lot of people, particularly the hedge funds, bought the Bitcoin and they didn't really care about it. It was a hot asset. So that starts the downturn. So we hit the all-time peak and then we have a downturn. But then what happens is Trump doubled down he said, well, all right, we'll hold off on the tariffs. But then he doubled down on them and everything starts to roll over again. So stocks start selling off. Well, now what happened is a whole bunch of the Bitcoin ETF purchasers were not, shall we say, long-term investors. They were very large hedge funds and very large institutions that were doing a basis trade. Okay. The futures price is here. The spot price is here. There's a difference. And over the course of the month, that future price rolls down. It's called roll yield. It's, and it can vary from, 5-6% to 10, 15. At one point, when it first got started, it was 30%. So that's 30% annualized for free if you're big and you can do that trade. And then you can lever it and you can make a lot of money. So what happened is, as the price starts collapsing, the difference, okay, and we get to the end of the month, the difference between the futures price and the spot price gets to an annualized rate of 5. Well, it costs me 5 to borrow money, so now I'm out. Right. So we have record, quote unquote, outflows from ETFs. Now, the one thing actually I am concerned about, right, is on the way up, it took 5, 8, 10 billion of dollars to kind of push us up 10,000 in the price, 20,000 in the price. On the way down, I mean, we had a couple billion, few billion. I think it was like 2.5 and then another 1.5 last week. So it was kind of 4-ish. 4 billion on a $2 trillion base is not a lot, but that's the problem. The concept of market cap, I think, is wrong, right? If you take the price for the last sale of a small amount and you multiply that by the outstanding shares of something or the outstanding units of something, and you say that's the market cap, well, but that's crazy, because if everyone wanted to sell at once, or even if a big shareholder, like if you had 1 million shares of Tesla and you wanted to sell 100 shares, no problem, whatever the price is. You want to sell 1,000 shares, it might go down a little bit. You want to sell 1 million shares, the price is going down a lot. So right. That's kind of what's happened. And there, so what I believe is happening, just my opinion. The other stuff I've talked about is those are facts.
Yeah.
This now is an opinion. My opinion is those same funds that do this arbitrage, and the same funds that would like to accumulate at a lower price now might not have covered their short completely. So they sold the long, but they keep the short on just for a little bit. You're not supposed to naked short, but it's just, I don't know. Sam just didn't get it covered. No, I should have said that. But
we'll say, Mark, that there are some of the macro forces that you described, and thanks for kind of going into detail on the pullback, because if you take a look at the 1 billion number, it scares some people. I can't help but think about one of our favorite movies, Trading Places,
baby,
where you start looking at more and more and asking about the frozen orange juice and kind of setting down the market. But I'm sure you saw the activity that Citadel, the Citadel with a capital C, responsible for 35% of stock trading volume, in the U.S., a staggering number. They're reportedly planning to become a liquidity provider for crypto markets. So I don't think that they have any North Korea ties, Mark, but this is a juicy conspiracy theory as far as what could manipulate prices down when you're trying to be a liquidity provider. But I am not going to spread that rumor. I'm just simply reporting.
It's not a rumor, X. It is an observation of, market fact that liquidity providers, whether it's Citadel or Wintermute, right? Everyone's heard about what's happening with Wintermute, right? Is they can control. Someone say manipulate, but I'll use control. It's a nicer sounding word. They can control the directionality of markets by deploying or not deploying their very extensive capital into markets. Look, Citadel, which started off as a little hedge fund in Ken's dorm room at Harvard, has grown into one of the largest financial services entities in the world, one of the most successful. They control, I think it's a much larger number of the options market makers.
Yeah.
I don't remember what the number is, but it's some gigantic number. They also are prime brokers in the sense that they'll lend people money. Lend people shares if they want to go short. So there are two things in this world I'm never doing. I am never borrowing a stock from Citadel or Goldman Sachs. Because I know they will be on the other side and they will just squeeze me out and I'll lose a lot of money. So if you're going to borrow stock from somebody, do it from someone who can't trade, like a Boney or State Street or something. Don't do it from people who now have perfect information, like Trading Places. Like if you know that the orange juice price is going to be announced or the crop is going to be announced at X, you can do what they did. Say, let's run the price down. Let's just run it up. And everyone, bring it in. And then you're like, and now we'll sell because now we have better information. And it's like, why is Robinhood's, I think this is right. I think it's their largest revenue line number. It might not be anymore, but it was a payment from Citadel for order flow. Well, what does that mean? It means Citadel gets to see what Robinhood traders are trading. Well, why would they want to do that? Well, their machines are so fast that if I say, X, I think I'm going to sell you 100 shares of IBM. While we're having that conversation and executing the trade, Citadel machines can go in and trade that like for fractions of a penny multiple times before our trade actually clears through the clunky system.
So probably one of the last stories, Mark, on crypto, and that what you described kind of reminds me of, those old Wile E. Coyote commercials where they overextend over the ledge, but they don't fall because they don't see the ground yet. And as soon as they do, they realize the gains. I think that speak to markets in some different ways. If you don't sell, you don't realize. So basically, the SEC is set to drop actions against Coinbase and other firms. So we know that this has been sort of a long time coming, right? So there were sort of lawsuits being pursued against Coinbase, Robinhood's crypto arm, on Open
Gemini,
Uniswap, Gemini, right? So this is being celebrated in our industry, right? Because it's kind of this reversion, of course, of regulation by enforcement under the Biden administration, and now it's sort of the clearing of the rules of the road. And I think that Brian Armstrong's quote, the CEO of Coinbase, was very revealing, right? It said, caving to their demands could have killed the crypto industry in America. If we had caved, it would have dramatically limited the scope of which crypto assets were allowed in the U.S. and pushed the industry farther offshore into the shadows. I commend the new leadership, and it's already in place for working to right this wrong. So I think that's, exactly what we talk about, Mark, that the market was moving offshore very aggressively. As VC investors, we've been tracking this, and we've always done where the best deal is. That's where we'll go. And so now there was a reversion, of course. There's a emphasis on trying to return back to the U.S. as a crypto center. And I think, when you look at some of those parties, they're big names. They all do different things. But if you take a little bit of the long view, so I guess maybe that kind of bridges this two ideas of there's the short-term pain, there's some macro pressures about, non-crypto assets that are influencing things. But then there's that kind of regulatory path where it's saying, okay, you guys are not the enemy. That doesn't mean that you can get away with everything, but that just means why you will play by similar rules to existing businesses that have been allowed to continue to grow when they have been new kids on the block. So, Mark, this I think is some welcome news for some of us.
It is actually the biggest news of the week. I mean, there's a lot of big news this week, but it's the biggest news of the week. And I give, and I sent from all of us at Morgan Creek Digital, huge hearty congratulations to the Winklevoss twins, to Brian Armstrong. I mean, these are unbelievable acts of courage. I mean, courage. And a lot of people have good ideas. A lot of people are smart. But courage, particularly courage in the face of government and enforcement and regulatory and jail, I mean, threats of like really bad stuff. I mean, both of these organizations stood up and said, no, we're not doing anything wrong. You told us these set of rules. We are complying with those rules. Now, if you're telling us we might not be complying with some rule you might make up in the future, that's kind of like a matrix kind of quandary. I would say it's like the joke of, the IRS says, hey, you owe me taxes. I'm like, okay, fine. How much? Guess. I don't know. 10 grand? Wrong, jail. And like, well, if you know how much I owe you, just tell me and I'll pay you. But don't play this game. And so the regulation by enforcement was brutal. And they were suing everybody, to your point, to try to lock down the system and push it away. They didn't want to outright ban it like China did. But Brian took like serious career and political and all kinds of risks, as did the twins. And both of them had offers, right? They both had offers from the SEC to say, hey, pay us money, admit you violated the law, and then we'll leave you alone. They're like, but we didn't violate any law, and I don't have to pay you money. I mean, why don't I pay you money? And so I big 2 thumbs up, huge applause for their courage. And it's the whole team. It's not just Brian and the twins. It's the whole team at Gemini, the whole team at Coinbase. And it's inspiring. It's inspiring to see the outcome. And look, we got Hester at the SEC to thank. She, Crypto Mom, has been a staunch defender of rights, even though she was overruled by the, Gary and his other 2, friends who voted with him, because it was always like 3-2. And we're in a different regime. We're in a regime now where companies are going to be allowed to focus on creating the future. And I was sitting with this amazing story. So there was a company that presented yesterday that has a new wallet company. And, here we are in New York. We got sirens going. It's awesome. Probably on the
Yeah, that's how you always know. We're not hearing them through our end, but in case we were concerned about the deepfakers wouldn't have a artificial siren in there, right? They wouldn't stop that.
That's right. But so this is an amazing story. So this entrepreneur, and he actually came out of the TradFi world, works at pension funds, and he was trying a bunch of different things, started a company. He was down to literally his last $50,000. He's almost bankrupt. And he tried a couple of things, and he came across this idea that, wallets are going to be the new thing, right? We all connect to the internet through our phones, and we kind of live our life through our phones. And he's like, well, digital wallets, your digital identity, your digital assets, are going to be the future. So he created this wallet company, and it has caught on, millions of users. He's cash flow positive, making money, and yet he just did a huge growth equity round to kind of go to that next level from a few million to potentially hundreds of millions, and raised $500 and something million from the big hedge funds, Coatue and Tiger Global, at a $3.4 billion valuation. That's a real company that now has millions of customers, and they're helping them, move into this digital age that we talk about every week. And that's an amazing story, right? And he couldn't have done that in a world where the SEC is down your neck saying, hey, if you hold that asset, you're violating securities laws. And so it's an interesting example of, one, just the ingenuity and creativity of these businesses, but I think more importantly, how the shift is now allowing this, I say, the most potent force in the universe, human creativity, to flourish with this tech innovation cycle that we've talked about, the 14-year cycle.
Yep.
Why we still believe that this vintage, right, the 24-25 vintage, might be one of the best vintages for investing in young companies in the past few decades.
Yeah, and we'll support that, Mark. Again, you are so on top of the transition to the chart of the week. It's scary because we talk about what the market is going to potentially look like based on what it had closed on. And before we kind of shift to that great chart, let's congratulate some of our portfolio companies that kind of are doing the building and have announced some very big news this week. Beginning with Bitwise, the Web3 degen native, our friend Hunter, who secured $70 million to expand his team and his on-chain solutions. They were the crypto native solution that was kind of grandfathered into, I guess it's not a medal round because there's more than 3 people, but there were 11. There was a short number of ETF recipients, and they were one, right? And so they have had an incredible amount of growth. They've seen 10x growth in client assets and their AUM surpassing 12 billion. And they were kind of the first in the space to kind of have these broader, easy way to hold crypto assets. Kind of to your point about making this more of a TradFi look and feel, but within the Web3 economy. And of course, our old friends over at Figure, where Sixth Street led 200 million has been committed to kind of help beef up their next step of the journey as they kind of look to that life, which what could be as a public company. So Mark, we're thrilled to be able.
Super thrilled.
Guys.
And I got to hang out with Hunter yesterday. I mean, Bitwise is one of the primary sponsors of Pomp's event. So we're all sitting in chairs draped with Bitwise banners, and Kathy Wood and all the glitterati are going to be speaking later, and Hunter is there, not as a bit player, but as a dominant player. They are the 4th largest digital asset manager in the world.
That's great.
It's pretty amazing, and just amazing. And then the night before, when I got here, I went to an event hosted by Figure Markets, and again they just had all the cool kids in the room, and Mike Cagney is just an amazing CEO, and I think about all this, and the company I was talking about before that I was like MoonPay.
Of course, yeah.
Which is why I got the Bitcoin Moon socks on. So now I'm tying it all in together. So, but the ability to see companies grow from fledgling startups to real companies, and now be talking about IPOs. I mean, Gemini thinking about going public again, and they had this great position in terms of being a trusted advisor to the administration, and Figure announced that they're going public, and there's all kinds of things that are so positive for the ecosystem. And it's so funny, the inevitability of what we talk about every week, right? The digital asset revolution. And that's digital asset in every form, like real world assets. Huge progress in the past week in companies tokenizing real world assets and putting things on chain and moving to an on-chain world, right? We had an offline world where there were no computers. Then we went to the online world, and that was a nice 40 plus 50 years. And now we're going to the on-chain world. Well, what does that even mean? Well, it simply means we move from a centralized world, centralized computing world, to a decentralized digital world. And digital is the future, right? It is a better way to transact. It's a better way to store. And as our ABCDs lay it out, right? Data is what's valuable, right?
Right.
The information that we record on everything, our habits, our work, our product. I mean, the data is everything. But you got to organize it, and you got to store it, and you got to structure it, and that's what blockchains do. And then you got to analyze it and process it and work on it, and that's what computing systems do in chips. And then you eventually got to make decisions with it, and have agentic tools that do our busy work for us, so we can spend more time being creative and unleashing that incredible power. So this transition in digital, and we talk about it's the exponential curve, right? You get better and better, not at a linear pace, but you get better at an increasing pace, an accelerating pace. And so we're at the knee of this huge exponential, and Raoul Paul calls it the exponential age. I think that's fine. That works for me. I like the digital age, but I think we're on the cusp of some just unbelievable transitions, and people's lives will get better. And look, it's not just the privileged few that won the lottery to be born in a really good country. It's everybody. I mean, there are people who, they don't have bank accounts. They don't have banks. They don't have access to financial services. What digital assets does is it unlocks the power to kind of be your own bank, to engage in financial services, to lend and borrow and invest. And you're talking about including now 8+ billion, soon to be 10+ billion people on the planet. And no, it's not going to eradicate poverty completely. And no, it's not going to get rid of all the maladies and all the problems we have that humans can create, because we are prone to bad stuff sometimes. But it is improving the lives of so many,
right,
and in so many ways. And it's such a blast to be involved.
Yeah, and
it's inspiring to be around these people.
Absolutely. It certainly energizes us. And I think that's what life is. It's the pursuit of what gives you energy, right? And I think within that unknowingly, Mark, we have stumbled upon an early thesis to Fund 5, if we're being so bold, ABCD, with E being for enterprise, evolution, and potentially exponential. As this,
I love it. I love it.
So, as we mentioned, Mark, the idea of, and coming full circle, seen markets start to dip, which is the best time to invest. We've seen, if you believe in the ultimate ascent of that market, let me be very clear. So with that point, which we do, we think that, not just our point of view, but actually who I think he was part of the show this week, Mike Novogratz over at Galaxy. His team put together this chart for those that are on audio only. This is the part of the show where I always plug in the YouTube feed, which allows us to do so many good things and interact. See if we're matching today. We're not. I'm going with the Crimson today. Actually, we gave a shout out to Stanford earlier.
Oh, wow.
With our buddy Stornetta, who was leading the charge there for so many years. We're seeing the chart really kind of demonstrate, Mark. This is historically, since 2016, crypto venture capital invested. And then the last part of this in green are some projections, which one of my old business school professors used to say, guesses, all right? So some guesses in terms of what this year may bring. We see, obviously, two sides of this market. There is 2021 and everything else.
You put up the chart X, and like I say, it's got this beautiful crest of activity, and then a trough, and this is the natural sequence of things, right? In the early days when we first started Morgan Creek Digital back in 17, 18, there wasn't anybody, right? There was Pantera, there was Blockchain Capital, little old us, and there wasn't a lot of money being raised. And then suddenly people like A16Z and Paradigm got formed, and then there were hundreds of firms. And by late 2021, you had this glut of capital being thrown at projects. And I always say, I love Keith Rabois' tweet back, I think it was November of that year. And he's like, yes, we've all lost our minds. We're all overpaying for everything, but you go first, meaning you come to your senses and skip this hot deal. And he joked, man, by the way, I'm going to take your capacity because I've still lost my mind. But yeah, what happens in venture is good begets good, begets more activity, begets more dollars, and eventually it's a self-unfulfilling prophecy in that you kill the golden goose. And so when there's too much money chasing too few deals, prices paid for too high, vintage returns are bad, and then nobody wants to invest. So there's a correction, as we've seen. And when you get a trough, like we have seen over the past 5 quarters, and you get the other two things that you need to have great vintages, which are talent, meaning you get people laid off from their day jobs and they have to figure out what to do. So they go create a new company, and a technological innovation. To have a good venture year, you need two of those three. So if you have, a dearth of capital and good talent, they'll figure out something to do. If you have good technology and talent, they'll figure out something to do. Even if there's not a lot of money, even if there's, a little bit too much money. So, but when you have all three, like you did in 1996, then you get really good stuff, And I think today with the TruthNet wave, massive layoffs in big tech, and not enough capital to finance great deals, I think we're seeing really, really potential for great vintages.
Yeah, and we're seeing that in numbers with the projected 50% increase this year, really driven by a couple of interesting projects, and you can take your guess about what the new hot area is on the blockchain side, Mark. But last year, I believe the largest funded blockchain industry was blockchain and AI, which we started actually 3 years before that. So basically now we're forecasting things like DPIN or decentralized physical infrastructure, and of course, tokenized real world assets. We have plays in these areas, and a lot of others are kind of looking at what this means for the growth of the market. But if we're kind of going to this idea of ABCDE, the idea is that more of these things are going to become enterprise. And really, when I think of that, it just means having value to real people that are getting the utility from the underlying technology to make their lives better and easier. So, if you can't get excited by that, then you are in the wrong business. So we wish you luck, Mark. I'm sure you're going to kill it on stage. And as always, we'll remind our listeners to rate, review, and subscribe. We do this once a week, sometimes more when we have guests, so look out for plenty more of us on the airwaves, and we'll remind us, as always, to stay current. Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.